But really what we need to talk about is gold, which has hit its lowest level in almost 3 years today, was on course for a record quarterly loss in price. At the same time, gold exploration company Giyani Gold made its debut on the JSE today after AMCU laid demands of 100% pay hikes for entry-level workers in that gold mine sector. Of course, Giyani expects to mine gold in 5 to 7 years from now, so they will take a long view on that. Well, let's look at that resources space and the possible effects of another mining strike blowout. Joined by Kobus Nel, who's mining analyst at Stanlib, and Shilan Shah, who's Africa economist at Capital Economics in our London studio. Let's start with you, Kobus, and let me put a dramatic question to you. We are accustomed to the gold industry. It's been the foundation of the South African economy since the 19th century. Will we have to get used to living without it pretty soon?
Now look, I mean, if you look back in history, at a stage we dominated global production, and today we're probably less than 10% of global production. So certainly we're not the player we used to be. And I guess the reality is we are in structural decline in that industry. Reserves and resources are declining. Our mines are already extremely deep. Many of them sort of seismic activity, which makes it very, very, very dangerous to operate there, as well as very expensive to be operating at those depths. So yeah, sure, it is the industry at this stage, especially given where prices are heading, that looks like it's in decline.
Okay, well, let's cross to Shilan in London. I suppose another way of putting the question I've just put to Kobus, Shilan, is we know our gold industry is in decline. It peaked in 1970 when we were by far the biggest producer of gold. I suppose the question is it going to decline faster than it could have declined because of factors that are in the country's control?
To an extent, yes. I mean, it's quite worrying, really, the disparity between what the labour unions are demanding for pay increases and what the mining firms can actually afford. If this leads to shutdowns, this is really going to weigh on the sector. Slightly less out of South Africa's direct control, of course, is the slump in gold prices that we've seen. This is probably more driven by global factors, including the potential tapering of QE, as well as you've mentioned, slower growth prospects for China and also India. So it's a combination of both, really. Either way, there's certainly reason to be worried.
Well, as you speak, we have a little, what we call a strap on the screen, talking about Goldman Sachs looking at a $1,300 per ounce for 2013 price for gold. Of course, forecasting doesn't always get us anywhere. Where would you see the gold price going, given the conditions we're in at the moment?
Well, I mean, it gets driven by, obviously, by speculation day to day. In terms of where South African mining firms would like it, a sustained period of gold prices below 1,400 is very, very worrying. It's really going to weigh on profitability. In turn, this leads to less kind of scope for a quick end to, or a quick resolution to the wage negotiations.
Just one more question before I put it to the panel, Shilan, and that is that your perception, it's always good to get an outside perception. We tend to gaze at our navel in South Africa. The mining industry, the environment in which the gold mining industry in particular, but also platinum, has to operate. What are the perceptions at the moment? There are these outrageous wage demands which can't possibly be met. What's more broadly the perception of where this industry is going in South Africa?
The perception is fairly bearish from our end, most certainly. As you point out, it's really very difficult to see how these wage demands can be met. It's almost certain that both sides, both the mining companies and the labour unions, will end up disappointed with whatever agreement does get reached. This is certainly going to damage investor sentiment, investor confidence. We saw that last year, and the previous 2 years around wage negotiation time. It's certainly weighing on sentiment towards South Africa.
Derek?
I think just from my side here back home, Cobus, just looking at the gold price, and you know, the comment was made that the gold price is very much driven by sentiment, and you know, that obviously changes on a day-to-day basis. Moving towards that $1,200 mark, is this not an opportunity in your mind, and where do you see the gold price going? What's going to give it a sustained recovery, to give it some natural uptick and consolidated sort of movement to the upside? And what's going to drive that, in your opinion? And yeah, I mean, generally, is it an opportunity to start looking at gold? One can argue that we're sitting on quite a weak rand at the moment, and potentially weaker over the coming months to come. And if that's the case, maybe this is an opportunity to start looking at perhaps a rand dollar ETF that's got some gold exposure. What are your thoughts on that?
Yeah, sure. Maybe to the first part of your question, you know, the gold price certainly on the way up also exceeded many people's expectations, and we've almost seen a feeding frenzy at a stage when the gold price would just, where people kept on bidding it higher. Certainly at the moment we are seeing it's snapping through resistant levels. I think you know, that in itself triggers stop losses, and you do see a lot of selling, you know, enforcing, with lack of liquidity, enforcing prices down, maybe to levels where one wouldn't justify them, you know, from a pure fundamental basis, you know, from an average global, you know, price which the miners need to keep operating, etc., etc. So I guess from that perspective, one would likely see the gold price, you know, overreacting. I think if you look at the global gold space, you're probably looking at you know, a cost plus capex level of between $1,200 and $1,300 an ounce. So certainly there is a big part of the industry that's not making money at these levels. You know, for our South African gold mines, you know, they sat with margins of between 20 and 30%. You know, probably 6 to 9 months ago, and at the moment some of them, after including cost and capex, are actually not earning enough with today's gold price to pay for that, you know. And that asks again a lot of questions then in terms of the operations.
I suppose that comes back to my question about how many of these miners can survive at a low gold price, and I know the rand is weaker, but it doesn't help all that much. Shilan, Greg Katzenellenbogen has a question for you.
Yeah, Shilan, yeah, there's been a lot of talk recently that given the huge fall in certainly the US Treasury bonds, you know, I think the 10-year Treasury's lost something like 26% from its peak. That a lot of institutions are on paper showing huge losses, and have been forced to liquidate their gold holdings to rebalance their books. Would you say that there's some truth in that?
Yeah, I would. I think there's certainly some truth in that. You know, what tends to happen is gold and the value of US Treasuries move almost inverse to each other. So in order to balance up books, yeah, of course, you know, if companies have taken hits on Treasuries, then this could be the case.
Yeah, before we get too bearish on gold, you know, the Indians are pretty shrewd buyers of gold, and generally when you have a big fall in the gold price, they start coming in and supporting the market. So that's still quite possible. I don't think it's all doom and gloom for gold.
I think there's a fair point to be made there. You know, demand from the consumer perspective is certainly driven by Indian consumers and Chinese consumers. Having said that, though, you know, the prospects for the Indian economy itself aren't particularly rosy. You know, we've got, you know, there's expectations of growth to kind of normalize at around 5 or 6%, which is a fair slowdown from where things were a few years ago. And so the growth in demand for gold may not be as supportive of prices as it was around 10 years ago.
Cobus, let's just talk about those wage demands, 100%, 60%, these are the numbers being thrown about. The danger is that we get a false compromise. So we end up with 12% or 15%. And it looks good because it's much better than 100%. But in fact, 15% is too much. We think of Nick Holland at Goldfields. We think of Graham Briggs at Harmony saying we are not going to give double-digit increases. We just aren't. They said that a couple of months ago. They drew the line. So what are you expecting as a result of these demands? Because it'll be very difficult for them to climb down to single-digit numbers.
Certainly it looks outrageous, and you know, I think it's sort of a stab in the dark at this stage. There's obviously a lot of rivalry going on at union level, and I think they're trying to, the two unions, that's AMCU and NUM, trying to outbid almost each other. I guess one just got to look back also. You know, yesterday we heard that Aquarius Platinum was settling with the NUM at the Kroondal mine, which I believe was a settlement rate that was linked to CPI, and we believe it's not more than 10%. You know, sort of where the number stands at this stage. So certainly there is some sanity playing out in the sector, you know, and especially at these gold prices, you know, there is just no way that these companies can just pay whatever, you know, the demands is. It remains a global, it remains a sector that we got to be globally competitive to remain sustainable, and we got to always keep that in mind.
But even at 10%, you know, it's nearly twice the inflation rate.
Yep.
So that's still pretty steep.
It's also what I'm referring to as a false compromise. Everyone treats a 10% increase with relief, but we shouldn't be.
Yes. No, I agree with you. That, you know, that's a problem for South Africa, because, you know, the president said that people must have, you know, sober heads and come to an agreement. But I think we need to see, you know, someone in government say to the miners that, you know, you're just not going to get these huge increases, and otherwise the industry is, you posed the question at the beginning, you know, will we still have an industry in 10 years' time?
Well, it sounds like from our discussion that maybe we won't, because this could push them out of business.
Well, if from gold's point of view, obviously, if there's less production, you know, taken off, then that for the actual price of metal, then that should be pretty good for it, and then it will probably the miners will come back and start mining for it again.
Well, there you are, and the gold bugs will always say now's the opportunity to get into gold, and long term, some people might say you will kill yourself for not having got into gold now. So you never know with that metal. Thanks to Kobus Nel, who's mining analyst at Stanlib, and Shilan Shah from London, who is Africa economist at Capital Economics. Thanks for joining us. Into a short break now. More Business Tonight right after this, so don't go away.